Hi, this is Mike back with Blueprint. Hey, today's topic is about liquidity testing. First of all, let's talk about, what is liquidity testing? When and why do we need to apply liquidity testing for, mainly self-employed borrowers, of course, and how do we do this liquidity testing? All right. So what is liquidity when you run across it, when you got to apply it? Well, first of all, liquidity test is a financial test to confirm the ability for a business to continue. Fannie and Freddie give you two tests, evidence of distributions or evidence liquidity. Now, the reason you want to do this is if a business is heavily in debt, it may not be able to continue to exist. So the guidelines I'm pulling from, I'm going to go over in this short training, is from Fannie Mae B3307 and 5304.1 in Freddie Mac Section D. Now, FHA, VA, USDA, the other major agencies use, don't really reference this stuff. So I can only tell you what I'm going to say applies to Fannie and Freddie. Not a bad practice for the other three, but honestly, the governments, I think, are a lot more lenient about it. And if you don't do these tests, they probably won't say anything about it. Not going to sit there and back that up. I believe in being consistent as an underwriter, but I can't sit there and point you to a bunch of FHA, VA, USDA guidelines that explain this. So this training is focused on Fannie Freddie. So first of all, again, liquidity testing, what is it for? Well, Fannie Mae, right in their guidelines say this, the lender must use caution. I think the word must is strong. Must is not if you feel like it when you want to, right? That if you're going to pull money from a partnership or S Corp, and this does apply to regular corps too, through the K1, through ordinary income, net rental income, etc., it may be included provided that the lender can confirm that the business has adequate liquidity. Now, they use that term and they give you two ways to test liquidity: evidence of cash distributions or evidence of business liquidity. Let me probably explain this in a more, general sense. If you need to get $1,000 from me, if I owed you $1,000, I wrote you a check and you cashed it, and it went through and you had $1,000 in your hand, that's distributions. You wouldn't know how much I had in my bank. You wouldn't know what financial shape I'm in. But if you cashed a check, that would prove that I had the $1,000 and that I could, you could pay your bills with the money I gave you or I owed you. Now, if I showed you my bank statement saying, look, I'll get you some money out tomorrow, and you saw I had $10,000 in my checking account, right? And I didn't have any bills attached to it. It was my $10,000. That is liquidity. That shows you I could pay it out, right? Distributions show you did pay it out. Liquidity tests prove that you can pay it out. Either way, it shows the ability to generate income. Now, I've heard some people say that Freddie Mac does not care. I've seen Facebook posts that say if you can't do a liquidity test or have distributions, go to Freddie Mac. They don't care about it. Not true. 5304.1, very clear. A seller, a business must support the business has sufficient liquidity. The same terms that Fannie Mae is using. So that's why it's so important. Okay, they are in the guidelines. Okay, let's talk practically about why does this make such difference. Is it just a tax exercise that we don't care about? No, it has very real consequences for a borrower, right? So what is the problem? It's called debt. All right, you can't use the same money to pay back a borrower. You can't have $1,000 your checking account, owe 10 people $1,000, and then still pay your mortgage. Something's got to fold at some point. You can't spend the same dollar twice. Why do businesses have debt? Repayment of loan to investors, pay back of business credit lines. Maybe they were in the hole last year. Credit lines or credit cards or loans or stock options, or you're building business reserves that you have to have. But you can't pay back a credit card or pay back an investor and pay yourself. Again, keep in mind that a business owner is generating their own income to pay their own mortgage payment. That's why the guidelines say you have to prove financial stability to make sure that they can make the payment, the borrower can make the payment. So what does that look like when you run across it? So I'm looking at a 1065 and I see that the company made $200,000 profit. My borrower is half owner of the company. So in line one, they should have $100,000. Half owner of a $200,000 profitable company, it makes $100,000. Now remember, K1 is a tax document, not an income document. The IRS does not care if you're in debt up to your eyeballs. You don't get to say, oh, I made 100 grand. Well, only tax me on 20 because, I owed this money. I had car payments. I had daycare. I owed other people money. No, they don't care. They get their money first. So if it says 100 on the K1, but you look down the distribution section, it says 60. Why is there a big difference? Well, it shows they have debt, or they couldn't pay themselves, or they had to do reserves. And in this training, we're talking about liquidity, the two tests, which is distributions or liquidity testing. All right, so let's put this in real life about, again, the consequences here. So I've got Joe, the business owner, makes 100 grand, and I got Judy, the W-2 wage earner, who makes 100 grand. So both their tax documents, the K1 and the W-2, say 100 grand. But in real life, Joe, he pays 25 grand in taxes, same as Judy, because they make the same amount of money, right? So they pay 25 grand a piece in taxes. But Joe never received all 100,000 because he had business debt, and the IRS does not let you write down your income for debt. So in reality, Joe's got 35 grand after taxes and debts, where Judy has $75,000. What would that do to a DTI? Well, if Joe has 60 grand, that's 5 grand a month, and has, $3,000 in total debt, that's 60% debt load. That's not an approvable file. Where Judy has 100 grand gross, before taxes, that's 8333, and her DTI would be 36. So this is not some tax exercise. This has real life consequences, and that's why the agencies enforce this rule now. So the bottom line is, business debts are not tax deductible. Business savings is not tax deductible. All right, you can't spend the same dollar twice. Okay, so now we know what liquidity means, basically showing the business has the ability to pay the owner or has paid the owner. We know where the guidelines say, so we know what and why we do these things. How do we do it is next. So first of all, remember, distributions or liquidity, which is just a form of distributions or a form of liquidity, only really affect the self-employed borrowers with 1065s, 1120Ss, or 1120. These concepts do not apply to Schedule Cs or Fs. And again, we're talking Fannie and Freddie. So you have to prove evidence of receiving the K1, ordinary income, net rental, cash flow adjustments, right, on the 1120 or 1065. Liquidity or distributions does not affect any W-2 wages or guaranteed payments. Okay, it's really only the profit of the company. Now, people are like, no, it would affect W-2 and guaranteed payments. Again, not true, because if you look at a tax return, it says, hey, this is a 1065. We brought in this much money in Section 1. We had this much expenses between 9 and line 20, right? And it gives a total here, and then your profits on line 22. Notice the second thing under expenses is guaranteed payments. So your profit in line 22 or loss already includes the payout of guaranteed payments. Now, if this was an 1120S, it would say W-2 wages. So it's the same concept, right? So these distributions or this liquidity testing only is affected for K1's line 1 and 2. All right, or 1, 2, and 3. Now, another quick couple of things. People use the words solvency and liquidity as if they're interchangeable. That's not true. Let's explain the difference between solvency and liquidity. First of all, if you're solvent, it means you have cash and assets more than your total debts. So if you try to go to a bankruptcy court, you can't go bankrupt when you're solvent. Now you can have liquidity, which means you have enough cash to pay your bills this month, but you may or may not be solvent. So in other words, if like most Americans, I have liquidity but not solvency. If they stop making money and they were told to pay off every single one of their debts, their house, their student loans, their cars, their alimony, child support, they don't have enough money. But yet you can give them loans because they have good cash flow or liquidity. They can pay their payments. All right. That's what we're looking for is liquidity, not solvency. All right. So when you do the math, here we go. Here's solvency. I got 15 grand due for payroll this month, $20,000 in my building expenses. I have a mortgage for $250 that I owe on. So my total debts are $285 for this month. And that's my current balance and everything. My building's worth 500 grand. I have 20 grand in my account, my business account. I have $520,000 in assets. Guess what? I cannot go to bankruptcy court and say I can't pay my bills because the judge will order me to sell my building and pay my bills. But you're like, wait, I've got $35,000 in payroll and building payments this month, but I only have 20 grand. I'm bankrupt. No, you're not. You don't have liquidity, right? You're solvent. So you know what you need to do? Sell your building, take a loan on your building, whatever you got to do. Now, liquidity is different. So liquidity says, hey, same exact bills as 285. I only have a building worth 200 grand, but I've got 60 grand in cash in my accounts. So my total assets are only 260. I have enough money to pay my bills this month. I'm fine. I can pay my profits, my employees, everything. All right. I'm not solvent, but I am liquid. And that's what we're looking for. Don't interchange those two terms because they're not the same. You know, they have very different meanings and solutions. So here's Fannie's guidelines talking about, okay, we had the distribution test by proving they had distributions in the K1. What is a liquidity test? So here's the two tests they give you. Simply speaking, one is basically the cash you have in the bank or cash assets, and one is cash assets plus inventory. Now, when to use inventory versus non-inventory? The best example I can give you is if you're going to use inventory as cash, it cannot be an inventory dependent business. For example, I see a AutoZone and a Jim's Repair Garage next door to each other. AutoZone has $1 million of inventory in the shelves. Mike's or Jim's Repair Garage has $1 million inventory in the shop. When you go to AutoZone, if there's nothing on the shelves, you won't go there, right? When you go to Jim's repair shop, you don't care what he has on the shelves. You're there to get your car fixed. The reason he has the inventory is that he or the business owner is trying to be efficient in their business. Okay, so that's the difference. You want to make sure, and that's just an underwriting discretion thing. Is this an inventory heavy business or not? Does it need inventory to survive? Would you go to a store if it was blank or had parts in it? Depends on what kind of store it is. Some places you go, you don't care if they have parts. Some places you go, you care if they do have parts. You wouldn't go to a mall if there was nothing in there to buy, right? You couldn't just walk around and buy it online. That wouldn't be good. All right, so this is how to do this test. Last part of the training here. So first of all, in a 1065, 1120S, or 1120, you have what's called the Schedule L. It's a balance sheet. Balance sheet is just, cash and assets, not income or anything like that. So on the far right is the end of the year statement. So if you're going to use 21 tax returns, you have to see where they were financially at the end of 21. Then you have to use 20 tax returns. You have to see where they're at the end of 20. Again, I've heard some underwriters say, oh, pull current bank statements. That's like saying, hey, I'm doing a purchase transaction and this is, July of 2022. Show me your bank statements from 6 months ago and see if you have money. No, you have to line up the bank statement with the year. If these people were, if the business was flat broke at the end of 21 and happened to take a big old loan in February 22, you can't use current bank statements to validate last year's income. They have to be in line. You have to be in line with the current tax year. You can't use a current one and back up, old tax returns. Not going to work. All right. Now in green, I highlighted the lines that are liquid. Lines 1 delta, 2 Bravo delta, and you could do like government obligations 4. That's pretty, 4 and 5 are iffy. I don't really light them up. Current assets 6. This is without inventory. So you add up what's in these 3 lines, and then you add up 3 immediate debts. Accounts payable, because again, this is like, hey, if you have right now, it is Tuesday, and you're getting paid on Friday, and you have $3,000 in your checking account right now, and on Friday that you owe $5,000 in your mortgage, do you really have $3,000? No, you don't have any money. Matter of fact, you're in the hole because you can't even pay your mortgage right now. So if I look at the cash, but they have so much debt down here that the cash won't cover it, they're not liquid. They can't pay themselves. That's the problem we're trying to check for. So you add up the immediate cash and the immediate debts, and that will give you a ratio. So when you divide assets by debt, you get a ratio. This 1.35 in this example means I have $1.35 cash for every dollar debt. I'm liquid. Now, if it was 0.9, it would mean I'm not liquid. It means I have 90 cents in cash for every dollar of debt. In other words, I have more immediate debt than I do cash, so I therefore cannot make my bills. Because remember, the business owner has to pay themselves above and beyond after their bills, not before the bills. They have to pay themselves after they pay all their bills. Now, if you add inventory, just add in this where the red's at, and that's if you think the inventory really could be turned into cash. It's a judgment call. I gave you the example of the two different businesses. Okay. Well, now, once you're liquid, this goes back to my final statement, which was, hey, the guidelines say don't use lines 1, 2, and 3 if you can't prove distributions or liquidity. So if you run through your K1 on a 1065 in this example, and you got 57.5 of income on the K1, but you have no distributions and you fall to the liquidity testing, you can now use it because you pass option B, which is the liquidity testing, if your ratio is above 1.0. And then you can use your full income at 82.5. All right. Well, hope that helps. Look, I know this stuff is feels like CPA, master's degree stuff. It's really a little bit more simple, but I just hope this training, will help you understand it. Okay, for future trainings, look for other videos. Mike Whitback with Blueprint. You have a great day.